Once we have created all of our individual budgets, we can create a budgeted income statement and a budgeted balance sheet using our previous budgets. So our income statement will tell us what our budgeted sales are minus our planned expenses. And the budgeted balance sheet, which is the very last budget in the budget preparation process, shows us the effects of all operations and cash flows on our assets, liability, and equity accounts. These budgeted income statement and budgeted balance sheets are also called pro forma income statements and pro forma balance sheets. We have an example here of a budgeted income statement for April from the information that we just looked at for the same company that we just looked at. So we have our gross sales revenue minus any discounts for early payments and bank service charge, which gives us our net sales. We then have our cost of goods sold off of the cost of goods sold budget. We have our selling and administrative expenses off of the selling and administrative budget. And then we have any interest expense that we budgeted, and that gives us our income before income taxes. Then we have our income tax expense and our net income. We can then look at our budgeted balance sheet. We have projected cash from our cash budget, net accounts receivable, our direct materials inventory, and our finished goods inventory, which is off of our purchases and production budgets, and how those accounts affect our total assets. We then have any income tax payable, which came off of our pro forma income statement, and if there's any changes to our stockholders' equity. In the budgeting process, we can also do sensitivity analysis or what if analysis and scenario analysis. We might create forecasts with a best case, worst case, and most likely scenario. If we have time in class, I hope that we can get to an Excel forecast that uses a best case, worst case, and most likely case scenario. Budgeting in service companies doesn't have production. So we don't have the same considerations with the manufacturing budget, where we need the production budget, the direct purchases budget, the direct labor budget, and the cost of goods manufactured and cost of goods sold budget. We do have to focus our budgeting process on any personnel planning based on what services we do provide. We have several alternate budgeting approaches. Zero-based budgeting is a budgeting process that requires managers to prepare budgets from a zero base. So this allows no activities or functions to be included in the budget unless managers can justify their needs. We need to every year look at all of our budget items to make us aware of all of our activities and functions that are outlived our usefulness. This can be a difficult and time-consuming process, but zero-based budgeting is becoming more and more popular for a lot of places. So this, instead of using historical information and carrying over historical information, we would start our budgets from scratch every single accounting period. Another alternative budgeting approach is activity-based budgeting, which is a form of activity-based costing. This just uses the firm's activity-based system. So we segregate costs required for the budget output into cost pools based on activity. We also have time-driven activity-based budgeting, which is in conjunction with the time-driven activity-based costing system that we looked at in a previous chapter. Both of the activity-based and the time activity-based systems facilitate resource capacity planning. And that helps us look at our practical capacity versus our theoretical capacity. We also have Kaizen budgeting. Kaizen stands for continuous improvement. So this budgeting approach incorporates continuous improvement expectations in the budget. This can be used with any other type of budgeting system. With a Kaizen budgeting system, we believe that we can continuously improve. So, for example, we had the learning curve example from last chapter, from chapter 9, where we looked at that if we have repetition in production, we can become more efficient and reduce the time. That's part of this continuous improvement. So we would believe that we can get more efficient and take less time and therefore have less cost in every single budget. We can have behavioral issues in budgeting. So one of those is budgetary slack. Budgetary slack is a cushion that managers intentionally build into budgets to help it make it easier to actually hit budget goals. So one of the performance evaluation measures that we're using to measure how well managers are doing at their jobs is whether or not they're able to meet their budget. We can incentivize managers to build in this budgetary slack, which gives them goals that are easy to hit. Spending the budget is another issue. So managers often feel if they do not use all of the resources they receive, that next year's budget will be cut. This is really a problem in government and nonprofit areas where they're given a set of amount of money each year and they might have a use it or lose it attitude. So spending the budget then becomes if we have excess budget at the end of the year, we find ways, and it's not always the best decision because we're usually generally trying to spend as fast as we can just to make sure it's all used up. So we end up spending it all within the last couple of weeks of the year, any leftover money that we have. Goal congruence is the degree of consistency between goals of the firm and goals of the employees. So how do we get employees to agree with the goals that the managers have? If we involve employees in the budgeting process, this helps to foster goal congruence. If we bring a budget in from the top down, then we might not have the buy-in and the goal congruence from the employees for that budget. So other behavioral issues in budgeting. Is it an authoritative or participatory budget? So is it top down or bottom up? Effective budgeting combines the two types. We also might have a difficulty level of a budget target. An easy budget might not encourage employees to give their best efforts, while a very difficult target can discourage managers from even trying. If budget targets and goals are set so high that they cannot be attained, then employees will get discouraged and stop trying to hit them. So you want to try to find an achievable target in order to incentivize employees and managers to hit or exceed the budgeted figures. You also don't want to create goals so high that we encourage managers and employees to commit fraud in order to hit targets. Additional behavioral issues in budgeting are if we link the compensation of our managers to budget performance. Then managers will try to game the system or find ways to hit their budget by creating budgetary slack, or committing fraud, or smoothing their income and costs in order to make their goals harder. So it's kind of a difficult thing if you link manager bonuses directly to their performance on their ability to hit the budget and budget goals, then you can create other behavioral issues by creating that incentive to game the budget. And last, we can improve that incentive compensation by using relative performance, by involving financial and non-financial measurement systems, use rolling forecast budgets, and using a linear compensation plan where our entire compensation isn't based just on hitting budget targets.